Good afternoon. Today, we will be speaking about investment opportunities of Marathon Petroleum Corporation and some of its larger competitors. All of our companies of interest trade on the New York Stock Exchange. In 2011, Marathon Petroleum Corporation split from Marathon Oil and became its own publicly traded company. They are responsible for all midstream and downstream operations of Marathon, including refining, transportation, and marketing. ExxonMobil and Chevron Corporation are both large companies that are part of the Dow Jones Industrial Average, and ConocoPhillips is the world's largest pure exploration and production oil company. The oil industry has experienced some drawbacks since the price of oil decreased by 50% in late 2014. Many companies have struggled to grow in the past few years due to this reduction. However, we still believe that there are investment opportunities within the space. Marathon is the smallest of our four companies and only operate in the eastern United States. Since splitting from Marathon Oil, MPC has increased their dividends a total of 26.5%, including a 15% increase of quarterly dividends in February 2018. They have returned over $13 billion to their shareholders since 2011. They also experienced a record-setting year for Speedway, which is a chain of gas stations and convenience stores owned and operated by MPC. They operate 2,740 stores in 21 states and are planning large investments into their Speedway locations. Marathon's midstream operations are almost entirely owned and operated by a master limited partnership, MPLX. This gives substantial tax benefits to Marathon's refining operations while allowing them to have more liquidity in an open market. MPLX nearly doubled in size this year while reducing its cost of capital. Marathon was also able to capitalize on the signing of the Tax Cuts and Jobs Act and ended 2017 with an effective tax rate of negative 14%. Marathon is now the second largest U.S. refiner of crude oil on a throughput basis, thanks mainly to the Galveston Bay and Garyville refineries, the second and third largest refineries in the nation respectively. Marathon is investing $400 million in the Galveston Bay refinery in an effort to update refining methods and increase crude throughput, allowing for higher operating margins. They plan on making similar investments into the Garyville refinery after a 2018. The negative 14% tax rate gave a $460 million boost to Marathon's net income, which they plan on reinvesting into the company, as well as increasing future dividends for shareholders. We do not, however, expect Marathon to receive a similar benefit in the coming years. Marathon is increasing their investment into their brand Speedway by $150 million, totaling a projected $530 million investment in 2018 expansions and renovations. Speedway also has over 6 million members in their Speedy Rewards program, which managers believe to be a huge reason why consumers choose their stores over other competitors. Finally, Marathon plans on increasing their barrel export capacity by 29% by 2020, which is consistent with their planned investments to their refining and transportation portion of the business. Being able to refine and export large amounts of barrels is key to increasing net income, so we believe that they have great growth potential. And now we will examine some of Marathon's competitors in the oil industry. ConocoPhillips has been harmed the most of our four companies by the drop in oil prices, and they have failed to produce positive net income in each of the past 3 years. They did, however, make a profit in the first 2 quarters of 2018, but this does not warrant complete optimism for the future. Given its lack of earnings and fluctuations in the price of oil, we do not recommend buying any shares of ConocoPhillips. Though both Chevron and Exxon have been increasing dividends since the downturn of oil prices, analysts believe that they will experience slow but steady growth in the next 5 to 10 years. Exxon has announced that they plan to double their earnings by 2025, but they have seen no significant realized gains, and analysts are not optimistic that they will reach their goal. Chevron currently has no future large investments underway and plan to hold steady until oil prices are a little better. Therefore, we do not recommend buying shares in either of these blue chip stocks. We see Marathon as the most exciting investment opportunity of our four companies. They are significantly smaller. That is partly due to their split from Marathon Oil in 2011. They have planned huge investments into the expansion of their brand and into their refineries, and we think that they have a much higher growth potential in the next 3 to 5 years compared to their competitors, including Exxon and Chevron. Therefore, we believe you should invest in Marathon Petroleum Corporation. Thank you.